Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist of Wealth Press. Today is what? Today is Tuesday. It's August 30th. August is almost behind us. It's about 8:06 in the morning. The market's going to open up in about an hour and 24 minutes. And as I always say, if you guys are enjoying these videos, if you're getting value out of them, post some comments below this video. Let me know what you like about them, what you don't like about them, what you'd like me to show you on them. All right, please do. I really would appreciate it. Now, let's get into the analysis. Today, the market is up about 160 points. It was up higher, actually, on the Dow about an hour ago. It was up about 220 points. The Nasdaq is up about 110, which is pretty good in light of the fact that the market sold off the last few days. What's interesting is today is Tuesday. Typically on Tuesday, we have a turnaround day if Friday and Monday are weekdays, and they are. And turnaround Tuesdays are accurate about 75% of the time. So if, in fact, the market is stronger today, it wouldn't be a big surprise. Now, usually these short-term turnarounds don't last too long, and I want to remind you, we're still in a major downtrend, getting a little choppier, but we are still in a downtrend. I want to show you the bond market, and it's something we have to keep an eye on every day, because if the bond market starts breaking lower beyond a certain level, we're screwed, because that's going to put more pressure. That's going to tell us that the Fed and the market participants believe interest rates are going to go higher faster than expected. At this point in time, notice we're still within that channel. Now, I keep showing you guys this channel because the longer we can stay in this channel without breaking, the higher the odds are that interest rates will not go as high or as fast as we expect. Notice this is interest rates going higher. Remember, bonds going lower means interest rates going higher. They're inverse. So they're going down, but look, in the last several months, they're just going sideways. So the longer we can maintain this sideways bias, the more it'll stabilize the stock market in the long term. And if you look at the stock market, especially the Qs, you will see that they're now entering that range once again. But it doesn't mean they're going to break lower. It means they could just stay within here. And what's really interesting is some sectors that have been really lagging behind, like consumer discretionary, they're now starting to firm up around here. Now, I do believe they're going to break lower, but if we get a little bit of a bounce here, it'll be a good sign to show that the market is, in fact, looking at this or interpreting, this as the current low. Even if you look at Cathie Wood's stocks, if you look at ARK, you will see that it's doing exactly the same thing. It's in that channel. Look at Cathie Wood's, right? And look at the bond market. And you tell me they're not correlated right now. You see what I'm saying? A picture sometimes is worth 1,000 words. And if you think the small caps aren't correlated to consumer discretionary or big caps, they are. Come on, let's be real here. So today we have consumer confidence coming out. This is a very important report. Let me explain to you why. Now, it's not as important coming out after the GDP last week, but still it is. Why? Well, because what happens is they survey 3,000 households each month to see if conditions or if they're expecting sentiment to change. Now, I would imagine the sentiment would be getting worse, but here's the interesting part. And I know, go with me on this one. Notice how and I'll get into more of this when we talk about global economy. But if you look at price, if you look at the stock market, let me show you something interesting here. I think you guys are going to like this. So if you look at my, let me just put it on a normal screen. This is the sell-off we had after the Fed announced they're going to keep raising rates, right? This is what the market saw. This is what the market interpreted. So most professionals were like, why is the market reacting this way? We know the Fed is going to keep doing what they're doing. But the reason the market went down like this is because a lot of participants, it's obvious, actually thought that the worst was already way behind us and the Fed was going to start lowering rates. Now, I think that's silly, and I don't think that's coming for a long time. But that must be what the market participants thought here, which is kind of bizarre. But my thought is this. If so many market participants thought that the market was getting bullish, and when it wasn't, that the Fed was going to start slowing things down, and they were so surprised that they sold off, wouldn't that impact on consumer sentiment? Because this is lagging. Wouldn't this also be in here? Wouldn't that also be that expectation that things are getting better be in here if the market sold off so much on what we thought was normal news, right? So that's why I'm thinking that the number can actually be slightly better than expected because of the surprise that the market gave us. I mean, it sold off when the Fed said we're going to keep doing what we've been doing and what we said we were going to do. So it's kind of like, well, why are you selling off if you're not thinking? And afterwards, the word came out that a lot of people thought that the Fed was done or the Fed was going to start lowering rates soon. And that's shocking to me. But if that's the case, then some of these consumers, some of these 3,000 households must have thought the same thing because the market stopped going down and it's been bullish. So I'm thinking that they might have got caught up in this bullish run right here, you see, before this came out, because that's what this is showing me, that people were taken surprised by this. I don't know how or why, but again, that's none of my business. But I think that the consumer confidence is still going to get caught up in this rally we had here. It'll be interesting. It's coming out after the market opens in about an hour and 49 minutes to be specific with you. Let's talk a little bit about global economy. Global stocks and Wall Street futures rebounded Tuesday as investors digested last week's Federal Reserve pledged to fight inflation by keeping interest rates elevated. Maybe now they finally realize, why are we all so surprised? I mean, this is exactly what they said they were going to do. I mean, are investors so short-term thinking that they think the Fed is all of a sudden going to start lowering rate? I mean, come on, let's be real here. Stocks tumbled after Mr. I'm not going to predict the future until I get reappointed Powell indicated Friday that U.S. central banks will stick to a strategy of rate hikes to cool inflation that's at a multi-decade high. What a surprise. I'm amazed. I mean, is this like something you guys didn't know? Or come on, everyone knew that. That's why I'm so surprised the market sold off so much, like it was a big shock. That appeared to quiet speculation that the Fed might ease off due to signs that economic activity is cooling. I mean, come on, let's be real here, folks. It's not going to happen overnight. Selling on Monday was widespread. Tech, healthcare stocks were the biggest decliners. Energy and utilities rose, as we expect. Fed officials pointed to a strong U.S. job market as evidence that the biggest global economy can tolerate higher borrowing costs. I agree with that. Some acknowledged a recession is possible, but say that might be necessary to extinguish surging inflation. And I think we're already in a mild recession. I think we've been one for the last few months, or actually about a quarter and a half. Some investors had hoped that the Fed would ease up if inflation subsided. Like, why would they do that all of a sudden? Nothing really changed. That sentiment led to a rally for stocks in July and early August. And that's what I'm thinking. I'm thinking that consumer confidence got stuck in this in this little bubble right here. We'll see. It'll be interesting to see. Investors expect another large rate hike at the Fed September meeting. Yeah, another 0.75. Though the likelihood of such a big increase is smaller following a weaker than forecast July retail sales. No, it's not. They're still doing 0.75, maybe 0.50. It's not going to change anything. Let's be real here. The Fed's preferred gauge of inflation decelerated last month, which gives us some hope that it might have peaked out, and that means the worst is behind us. But that doesn't mean they're going to start lowering rates. I mean, what they're doing just started working, while other data shows consumer spending slowed. Wall Street will get several updates on the economy this week, including this consumer confidence report. And we've got ADP data tomorrow. That's a private report that's going to reflect on employment situation. And then you've got the manufacturing index and the jobless claim. It's not a huge week for reports, but it is very interesting. And we had Best Buy report numbers. Now, the reason why I'm focused on Best Buy is not because it's such a big company or it's going to move the market, but this company focuses, it's a retailer of technology, and it's one of the few outside of Amazon. So it's kind of interesting to see what they're expecting. And they're talking about posted decline second quarter. They're talking about, again, higher costs that ripple through the supply chain, weakened consumer demand, electric chain struggled, all of this stuff. But revenue dropped 13%, not like 50% or 40%, 13%. That's not that bad, right? Now, net income fell 60%. That's huge. That's huge. But revenue fell 13%. Analysts were expecting $1.27 a share. They got $1.35 a share, but revenue only dropped 13%. So spending is still there, and a lot of the net income is not there because of the supply chain issues. So again, we got to be careful. For the year, they're sticking to their previous forecast of an 11% drop in comparable sales. That's not a major recession. That's just a mild setback. Looking ahead, it expects comparable sales will decline more than the 12.1 decline. But again, for the year, they're looking at 11%, even 13% drop. It's not crazy. It's not like a 30% or a 40% drop. So I'm encouraged by that. Again, I think the market's going to bounce off today, maybe regain some of the ground that it lost last week, because I think we're still in a choppy sideways market because mostly of the bond market. Now, so I'm not expecting a lot of directional bias. In terms of sectors, I warned you, and I want to show you something else. Remember about 2 weeks ago, we had, let me show you this. Let me go back 1 week. Look at the number of stocks a week ago. Let me go back another week. Back 1 week. Let me go back another week. Let me go back for 10 days. Oops. Let me go back 10 days. Look at the number of stocks making 20-day highs and look at the number of stocks making 20-day lows. Huge disparity. Now look at today. Hold on. 65, 380. You see a difference? All of that stuff that went higher, all those stocks that made 20-day breakouts now are making 20-day breakdowns. So we went from being way, way overbought to way, way oversold. So I think we're going to bounce for the next day or two. I wanted to show you the ratio of stocks making 20-day highs versus lows. And I wanted to also show you the 11 sectors and show you that right now, energy, utilities, consumer staples. I told you we would get back there. And on a monthly basis, energy, utilities, industrial, this is going to drop. I'm telling you right now, this is going to be energy, utilities, consumer staples is going to be leading for quite some time. You want to be in defensive sectors. Expect some choppiness, a little more volatility. We'll get a better idea of where we stand over the next few days. But today's Tuesday, and typically when you have a weak Friday and a weak Monday, you have a pretty darn good Tuesday. We'll see if that plays out. Now, before I let you go, oh, and by the way, strongest sector is energy, and strongest stock is Occidental Petroleum. Nothing changed. Weakest sector, I almost forgot. Weakest sector, communication services, and weakest stock in the communication services, Dish Networks. Definitely Dish Network. I hate Dish Network. I think this model is so outdated, it's ridiculous. Now, before I let you go, I recently teamed up with Jack Carter, who has over 35 years of trading experience, to develop a brand new system. We're calling the system the S3 Advantage. That's right, the S3 Advantage. And you can get all the details about it today at 1 p.m. Eastern Time. That's right, 1 p.m. Eastern Time. Now, I really think you're going to like what we've created. I mean, this is very, very cool. I'm super, super excited. If you like building systems or using them or learning how to get involved in some algo stuff, folks, the timing couldn't be better. Jack Carter is all in, and I want you guys all in. This is the coolest thing since sliced bread. Follow the link below. Check out this session. It's brand new, all meat and potatoes. You guys are going to love it. 1 p.m. Eastern Time. Don't miss out. Bye, guys. Love letters, comments, email, support@marketgeeks.com. I want to hear from you. It's been a while. I miss you.